Thanks everybody for being on here today. I know that you're busy, so we're going to get straight into it here. If you don't know who I am, my name is Daniel Ryan. I'm a certified financial planner as well as an IRS enrolled agent. You might also know I'm the author of the book, Oregon Public Retirement, which I was just showing everybody. This is 23 chapters, almost 400 pages, chock full of everything you need to know. That's why the subtitle is called The Financial Planning Playbook for Oregon Public Servants. I'll talk about that more in a second. But just so you know, I am the founder of Ryan Financial Solutions, and I did write the book, Oregon Public Retirement. You can find it on Amazon. It was a #1 new release last year when I published it just over a year ago, and I made it as inexpensive as possible. You can actually get the Kindle for 99 cents. But as you know, if you're waiting, I got the ebook for you on my website for free. If you're a union member, you can go to my website. I'll show you how to do that here in a second. I find that the print version is easier, of course, so that you can go back and check out different parts. And I have the table of contents made really easy so you can find exactly what you're looking for if you're trying to piece it together in different segments rather than read the entirety of the book, for example. If you want to check out the podcast, Oregon Public Retirement, the YouTube channel, which is at Oregon Public Retirement, or go to my website, ryanfinancialsolutions.com. And you'll find the free audiobook, free ebook for union members. If you go to ryanfinancialsolutions.com and you can schedule an appointment, be happy to answer your specific questions at that time. But in this kind of a context, usually I have more questions for you than answers if you ask me a question that's specific to your circumstance. So like I said, go to ryanfinancialsolutions.com, schedule that free appointment. It would be awesome to get to know you, answer all your questions. If you're looking for someone to implement some of the strategies that we start to talk through, that's where we can help people with their tax preparation, tax planning, investments and distribution and pension planning, and all these different other topics that, of course, I write about in the book, but really trying to make sure everyone knows that I wrote that book in particular so that you had everything you need if you want to try to do this all on your own. That being said, let's dive into it. Today, we're talking about all about PERS, right? We got the individual account program. We have the PERS pensions. We have so much to talk about. So let's dive right into it. Now, the most frequent question I get, or maybe even statement, and it's a myth, is, Daniel, I'm in multiple PERS pensions. And they say, I'm in tier 1 and tier 2. I say, well, that's actually impossible. So we got to start to break this down right from the get-go. If you're someone who has thought that you are in both pensions, you are not correct under all but one circumstance. I'll explain that in a second. I have a whole video on what loss of membership status is. But let's dive in and make this simple. If you're a tier 1 person, it simply means you were hired before January 1st of 1996. Then if you were hired in between January 1st and August 28th of 2003, then you're in tier 2. And if you were hired ever since then, last 20 years, you're in OPSRP, or the Oregon Public Service Retirement Plan. Now, I always ask people, how many times can you be hired for the very first time? And the answer is once, unless you get into a loss of membership status. But that is a very, very rare circumstance. We have a few clients in that case. But other than that, you can only be hired for the first time once with a PERS employer. So now it's helpful to understand what PERS pension you're in. You can only be in one of them. But everyone comes back together for the individual account program. Now, I know I talk fast. I get very excited about these different areas within PERS. If you don't know my backstory, my entire family is in the Oregon Public Service arena. So my father and my grandfather, my brother, my wife, literally everyone in my family has some background in firefighting or education. Very passionate about Oregon Public Servants. That's why I created Ryan Financial Solutions several years ago. So the IAP is a lump sum. I call it the glorified 401k. It's where your contributions of 6% have been going for the last 20 years. So if you're a tier 1 or tier 2 person, you've actually been starting out your career, you were contributing to your pension. Then in 2004 and ever since, you've been contributing to the IAP, not your pension. There's no guaranteed rate of return in this account. So a lot of people are confused if their PERS statement says their benefit is going to be XYZ per month. Is the IAP included in that? No, it's not. It's this lump sum dollar amount. So you have both a monthly pension and a glorified 401k, or what we call the IAP. Now, there's some great benefits. Number 2, fully inheritable. So that means that if you did, in fact, pass away, which would be the saddest circumstance, and I don't even like talking about that, but if that did happen, and let's say that you have $150,000 in this account, well, that would go to your spouse, or maybe to your children, or maybe your friend, or whoever you have put as your beneficiary. And I won't even get into all the details of estate planning with PERS documents. 99% of people don't even know that there are estate planning documents directly with PERS. So please check more into that or get the book, and I will walk you through that in the book. Now, number 3 is based on your age, you're going to be in what's called a target date fund. That means that they're actually investing the money in your IAP appropriately based on how old you are, more likely when you're going to retire, so that it gets more and more conservative as you get closer and closer to retirement. The last thing is that when you do get to retirement, you're going to be able to distribute this money in many different ways. And on the PERS application itself, they're going to ask you, do you want to have all of this in one lump sum to your bank account? Maybe you can put it into an IRA if you want to do it that way, or you can keep it with PERS and ask them to distribute it over time. Not very many people choose that last option because you can do it over 5 years, 10 years, anticipated lifespan option. And I'll talk about why we don't usually do that here in a second. But I want to clarify once again, where does this money come from to get the money into the individual account program? Got a question about vesting here, and going to talk about that more in just a minute, actually. So hang tight on that question. But you have this money on your pay stub that says it's going to Oregon PERS. And a lot of people get confused by that. And actually what's happening is your salary contributions are going into the IAP, and that's what they're showing you on your statement. So let's pretend for a second that you're an OPCERT member. I think a lot of times OPCERT folks think I'm leaving them out. So I'm gonna use them as the example today. And basically, if you had been hired 20 years ago in 2004, you might have a really considerable lump sum in your IAP. And that's what's going to be shown in the middle of your PERS statement each year. And that's what you're going to see in this part here. And then you have 6 options to distribute that money. Now, the pension itself is actually from your employer contributions, and that's not actually 6%. It's as high as 25% of your salary. When people are looking at their 6% contribution from the pay stub, not all of that is actually getting to your IAP anymore. And what's happened since 2020, when Senate Bill 1049 came into effect, is they actually created what's called the Employee Pension Stability Account, or EPSA. And that became a legal size document on your PERS statement, and they put the EPSA on the bottom. And people look at that number, they say, hey, I got $5,000 in here. It's not very much. I say, well, that's actually not your money if you choose to take the pension. It's effectively saying, well, instead of it all getting to your IAP, some of it went into this other account on your statement, and it's going to help fund your pension. So they're going to pay it back to you, but in the form of your pension. Let me give you an example. Let's pretend for a second that you make exactly $100,000 a year. And it used to be 5 years ago and before that $6,000 was coming out of your paycheck and going straight into the IAP. And back then, all $6,000 would make it into that. But ever since 2020, if you're tier 1 or tier 2, you still had $6,000 from your paycheck, but only $3,500 made it into the IAP. The other $2,500 per year has been going into your EPSA. And that's, again, helping you pay your pension. A lot of people got confused by that. And they said, Daniel, are they taken out of this $150,000 nest egg that I've got in my IAP? I said, they're not taken from that. They're taken from your contributions, not the lump sum dollar amount. Now, if you're in OPCERP, again, anyone hired basically in the last 20 years and beyond, you're going to have just a smaller EPSA, or what they call IAP redirect. That's very, very fancy language, of course. And that basically is 0.75. So if you make $100,000, $5,250 made it into your IAP, $750 went into your EPSA. I know that can be a confusing topic. And again, if you want to find out more for your exact situation, schedule that free phone call. I'll be happy to walk you through that. Now, what happened is they said, well, since we're making a huge distribution, not all of your money gets to your IAP, we're going to allow you to do what's called a voluntary contribution. And that can basically take the amount that was getting taken into your EPSA, and you can actually put that in on your own. And you can do that directly with payroll. You can do it on your PERS website. But I caution people, I have not found a circumstance that makes any sense. The reason is, going back to my example of a tier 1 or tier 2 person, you're going to give 2.5% and put that money in what's called after tax. That means you don't get a tax deduction to put that money into your IAP. And it grows and still gets fully taxed at ordinary income rates. That's the worst of both things. So instead, if you don't need the tax deduction, you should probably look at putting it into a Roth 403B, Roth 457, or a Roth IRA, and then having it grow tax-free. Not after tax, but Roth. That's the way to go. And of course, I have other webinars just on the tax planning side of things. But that's a caution for folks who are in that voluntary contribution program. You probably want to get a second opinion and see if that still makes sense. And again, I haven't forgotten about the vesting question here. I'm going to tie that back in here in a second. Now, like I mentioned, lump sum 5-year distributions for the IAP are probably the most common for folks. The least common are when you keep the money at PERS at retirement and you actually distribute over 5, 15, 20 years and so forth. Now, why is it such a problem to keep it at PERS? Well, the first issue is lack of flexibility. Now, what I find with Oregon public servants is that you got Social Security and you have your PERS pension, creating that stability, that monthly pension income that you need. But the other issue you need is flexibility of big spending. You might have a big cost of health insurance for just maybe 3 years, for example, or you might need a new roof or a new car before you get into retirement. You might want to pay off your house. You have all these other big costs. And that's where the IAP can really shine. If you put it into an IRA, for example, if you keep it in at PERS and do a 10-year distribution option, then if you needed more or less money, then PERS is going to say, hey, we're not doing financial planning for you. You just turned that on basically at retirement. We're just going to keep paying that same exact dollar amount until it runs out. And that's the issue. So number one problem is that you don't have the flexibility of distributions. The other issue is flexibility of your investments. For example, if you have $150,000 or $200,000 IAP, well, PERS is going to invest that basically in a glorified bank account. It's going to be in the retiree fund, and it's not going to be earning very much. Where you might want that money to keep working really hard. Again, the IRA is typically what people will do. Now, Daniel, what if I retired and I was 58, like a tier 1 person might be, or I was, 55 or something like that? Basically, you were not 59 and a half or older. Well, that's where we use Rule 72T, and that's where you can do substantially equal periodic payments. Again, that's why I love doing the tax planning and tax preparation for my clients, because a lot of financial planners don't even know what we're talking about. So that's what we can still do in an IRA. So almost all the time, that's what people are going to do. Now, I'm going to come back to that question that you had asked about vesting. So I'm going to first clarify what vesting is and then answer the question. If you worked in a PERS qualified position for 5 different calendar years, or you just turned 65 no matter what. So if you got hired in an Oregon Public Service role and you started at 63, well, 2 years later, you're automatically vested at 65. So that's the good news. What if you started back in your early career, you worked for 4 different calendar years, and then you took a really long break and you said, I don't think I like public service at all. Well, you're not going to get a pension because you didn't do 5 calendar years, 600 hours in 5 different calendar years, which usually turns into 4 school years, basically. But that if you don't do it, you don't get the pension. And so that's what vesting is. It's basically PERS saying, are you committed to this? Because if you're not going to get a benefit. You're not going to get a pension. So what happens is people actually do 5 years. And if you can get to the vested number of 600 hours into 5 different calendar years, you can take off as much time as you want, go work in the private sector, go work in another state like Washington, and then come back and pick up right where you left off if you were already vested in Oregon PERS. But if you didn't vest and you only had 4 years or less, well, then PERS is basically going to say, hey, if you're gone for more than 5 years, we're going to assume you're just not coming back and you go into what's called loss of membership status. That's what I was referring to earlier. It's the only time that you can technically be in 2 PERS pensions. What I've seen happen is that people were in tier 2. They didn't do 5 years. They only did 3 or 4. And then they had more than 5-year break. And then they came back after OPSERP pension had been created. And so they went to loss of membership as a tier 2 member. They came back to PERS as an OPSERP member. So technically speaking, you can be in 2 pensions, but only under that circumstance. Now, the official question that I was given here was, I'm 64, but it's only my 2nd year of employment. And I think I'm fully vested after I work 600 years in 5 calendar years. That's correct, with the exception that as soon as you turn 65, you're automatically vested. So hopefully that answered that question. Now, one of the other things that people have questions about basically is, what is wait time? Every PERS member has wait time of 6 to 8 months at the beginning of your employment. This is effectively PERS and your employer saying, hey, we were going to make sure that you stick around here for a little while before we just start making contributions to your IAP and all these other components within the PERS system. So everyone has 6 to 8 months where there was not creditable years of service into PERS. That's why when you see someone getting ready to retire at 30 years, they probably have to purchase their wait time to actually retire at 30 years. If you don't, then you probably end up having to work 30 and a half years, is basically how that works, so that you can get to that normal retirement age with PERS. The IAP contributions also begin once you are in your qualifying position for more than 6 to 8 months at that point in time. Okay. And does summer months count for school workers? Ooh, I love that question. Yes. Basically, what PERS does is if you are a school teacher or a member of a school district, which means any type of role, certified, classified, everything in between, then you actually fall into a category where they look at it per 6 months. Did you work 300 hours? Because to your point, July, for example, there's almost never any work history in that month of July. Also, December can get complicated because you might have 2 weeks off and not hit 50 hours in that month. So yes, school teachers and basically school people within PERS, you have to do 300 hours in a given 6-month period of time. Great question. Now, like I mentioned, if you didn't stick around for that 5-year period of time, then you might go into that loss of membership. But once you have 5 years or more, you're vested. That means you're going to get a benefit. So every time I say the word vested, think I get a benefit. The only exception to that rule is if your actual benefit is going to be less than $200 per month, PERS is going to write you a single check and they're going to say, hey, instead of giving you 10 cents a month, we're going to just write you one big check for $5,000 or whatever the actuaries come up with. Now, I like to have some participation. So think about this. You don't have to put it in the Q&A if you don't want to, but I'm going to give you an example now to illustrate wait time and membership dates, because that can make things complicated. So if educators have 6 to 8 months of wait time, that means that was not creditable years, creditable service credit for their pension. And if they were hired in 2003, August 1st of 2003, but they became a PERS member on March 1st of 2004, what pension are they in? And again, I just like to make sure that folks know that your PERS pension is based on your hire date. And so that would be a tier 2 pension member because they were hired before August 28th of 2003. And they became a PERS member in 2004. The question here, well, I have money going into my PERS account. Can I get a tax deduction while adding money to my IRA? Yes, it depends on the tax deductibility, depends on your income levels. So that's outside the scope of today's conversation, but you can put money into an IRA, a traditional IRA, and actually get a tax deduction. And in this current tax year, 2024, if you're under age 50, you can put up to $7,000. If you're over age 50, you can put up to $8,000 per person. So if you're married filing jointly, that would be a total of $16,000. The question of being a deductible contribution is going to depend on your income. Basically, if you make over $80,000 each as a married couple, then that would be a joint of about 160,000 or so. And that number keeps changing with the new tax years with inflation. And that would mean that you don't get the tax deduction if you make more than that. If you're single, filing single, then basically the tax deductibility comes down to about $130,000 of income. And if you're married filing separately because of maybe PSLF strategies, if you make more than $10,000 a year, which basically everyone does in this public sector, then you don't get tax deductibility. So the answer to that is probably, but it depends on your income levels and it depends on how you're filing your taxes. But great question. As far as the IAP voluntary contribution goes, I would recommend looking at the 403B or 457 because those do not require you to have income thresholds. The IRA does. So that's just a little difference here. Benefit eligibility. Let's talk about these calculations now. What about when I'm ready to fully retire? When is that? What's the soonest date that I can do that? If you're tier 1 or tier 2 and you have 30 years of service, you can retire under the normal retirement age calculations, which we'll talk about here in a second. If you're not going to get to 30 years, let me use an example of someone who maybe started as a tier 1 member at age 30. You're going to hit age 58 before you actually hit 30 years. So you would be 58 with 28 years of service. PERS says as a tier 1 member, it's okay. You're only 58. That's fine. You can still retire under the normal retirement age rules. If you're tier 2, you need to hit age 60. So just a slight difference if you have fewer than 30 years. Now, OPSERT members, this is where it gets a little bit more complicated because two things have to exist at the same time. You have to have 30 years and be over age 58. Now, let me use my wife as an example. My wife actually started teaching middle school at 22, right out of college. My wife is going to get to 30 years at age 52. But because she's not 58 with 30 years, that pension would be reduced basically and not even eligible to get to it until 55, but I'll talk about that in a second. So with an OPSERT member, you need to have both 30 years and be age 58. So sometimes what people will do is they'll keep working, 6 more years, and that will get them naturally to age 58, but you'll have like 36 years of service. Or you can just stop working and then come back to the pension and say at 58, I already had 50 or 30 years locked in at age 52. I'm just going to wait 6 years. That's when I will be 58 with 30 years. And you could have done something or nothing, I suppose, in between those time periods. Let's see, I've got another question here. So let's take a look. I make a lot more now than in 2005. Do I purchase wait time based on my 2005 income or now? That's a great question. You purchase your wait time at the 90 days prior to your retirement date. And that's going to include a written estimate, which I'll talk about here in a second, actually. A written estimate will tell you exactly what that cost is, and it's going to be based on the income level that you were at when you first started back in the day. That being said, if you started in 2005, that would tell me that you're an OPSERT member. And so OPSERT members, unfortunately, don't get to the ability to purchase time. Okay, unsure what my regular account balance means on my PERS statement for tier 2. Another great question. Probably that would make more sense here in a few more slides as I talk about the account balances and the calculations within money match and full formula. So if it's okay, I'm going to pause to answer that question here because it's coming up in just a quick moment. Now, what if I didn't get to 30 years and I just want to start collecting the PERS pension for whatever reason? Let's say that you have a big event, you basically moved out of state, so you can no longer work in an Oregon PERS capacity, but you really need the additional income because you can't find another job quite at the level of income that you need. For general service members, which all public education people would be falling into that category, it's age 55. But there will be penalties, or you can call it discounted amounts. Basically, if you're tier 1, you were supposed to have been age 58 if you had fewer than 30 years. So there's a 7% penalty each year. That would be 21%. 7 times 3 is 21%. So if you were going to collect a pension that was going to be, $5,000, it would be reduced by about 20% and thus become $4,000 is basically how that math works. If you're supposed to be age 60 for a tier 2 person, for example, that would be a 7 times 5-year reduction or 35% if you took it at age 55. And for OPSERT members, same logic, but that would be age 65, normal retirement age. So that would be like a 70% reduction if you did that. Probably not a good plan to take it at 55 unless you have the option to actually get to 30 years. Can I buy back years taught in another state? Potentially. Great question. Let's talk about those purchases here in a quick second. You'll see how that all starts to come together. So if you are a tier 1 person and you were hired before 1981, which is over 40 years ago, you have 3 different ways to calculate your pension. Now that's formula plus annuity. That's my grandfather's generation. That is almost never going to happen because, again, you had to have been working basically for the last 44 years. Just very, very unlikely that that's your circumstance. If you are a tier 1 person or even tier 2 potentially, then if you were hired and you have a pretty significant account balance on your statement, you might actually have money match be your calculation method. The reason I say that is because money match takes into account your age and your account balance. And you'll see that full formula has nothing to do with your age or your account balance. It has to do with your salary and your years of service. So if you're tier 1 person, you might fall into any 3 of these categories. If you're tier 2, it's only going to be the top 2. And if you're OPSERT, you only have the calculation under full formula. That can be confusing. So let's break it down. Money match is going to be for tier 1 members mostly, or those of you who have basically very, very few years of creditable service, but a significant amount in your account balance. So for that tier two person's question, if you have more than maybe $100,000 on your statement, that would be outside the norm. I usually find $25,000 to $50,000 is the account size balance for a tier two person. You're almost certainly going to be in what's called full formula, and that would not include your account balance. So nothing you need to worry about in that case for most tier two people. But for tier one folks who were hired in the early 90s, late 80s, those folks are sometimes still teaching. And you're very likely in the money match calculation. Now, the reason it can get complicated is because it takes into your account balance and your actuarial equivalency factor, which is based on your age, and then it matches it from your employer times 2. If I was to give you an example, let's say that your account balance as a tier one member or tier two member is $375,000. That's pretty significant, but back in the day, they were huge accounts. Okay, that's why PERS had to change some of these rules. If you had $375,000 and you were going to be age 60 when you retire, your actuarial equivalency factor, or AEF, is going to be 6.8. You take that and you multiply it as 0.0068 times 375, and that's $2,550 per month, times 2 is $5,500 per month. So you can see why this gets complicated. It is so unique to the month that you're going to retire and the account balance. These are things that people don't typically remember off the top of their head. I wouldn't blame you. You got better things, more important, pressing things each day to day going forward. That's why we have calculators and work with the PERS folks to make sure that we get that number for those of you in Money Match. If you're full formula, which is 90% of PERS members now, then basically as a tier one or tier two person, you take those years of service, your salary, you multiply it by a factor of 1.67. Now here we go. I'm going to make PERS super simple. If you're tier one or tier two, if I take 1.67% and I multiply it by 30 years, my math teachers might be quick on their feet. That's 50.1% of your salary. That's how that math works. If you're an OPSERP member and I take 1.5% as my factor times 30 years, that's 45% of my final average salary. So you can see that PERS is basically trying to cover half of your income in retirement for life. So that would be the simplest way if that's something that you're ever curious to learn. I have YouTube videos that go in depth as to what calculations come into final average salary, how sick time actually gets paid out into your final average salary, and how this all works together if you're not normal retirement age. So that can be its own video, literally 10 or 15-minute video that I have on YouTube just to walk you through all these details. But for the simplest of terms, that's how this calculation works. Now, let me double check the questions here because there was a couple of questions regarding this part here. Can I buy back years in another state? So that question is potentially, if you're tier one or tier two, you can do purchases. There's 16 different purchase options that might apply to you. One of them is out-of-state teaching. The requirement is that you cannot be vested in that other pension. So sometimes people are coming from CalSTRS or CalPERS or TRS or whatever different retirement system you came from. And if you're a tier one or tier two person in Oregon PERS, you can buy that time back if you have 4 years or fewer of service. But it's based on what that amount would be on an actuarial table. So sometimes it could be as much as $75,000. Which, again, we got to make sure that fits into the grand scheme because you run that break-even analysis of $75,000 from your 457 or 403B, and that increases your amount, gets you to normal retirement age, then it might make sense or it might not. So that's how that works, but it is certainly an answer that could apply to your circumstance if you're tier one or tier two. Now, the final average salary might seem simple at first, but essentially what PERS is saying is, hey, we're going to look at two different options. They always give you the highest benefit of the doubt, basically. Final average salary is going to say, if you have your last 36 months as your highest amount of salary, which for most folks is the case, then we're going to use that as your calculation for your final average salary. Or if you might have had different years that you got extra credit, sometimes people teach summer school or they became a school administrator or whatever they might have been, maybe the department head, things like that. Then they might cherry pick as well. And they might say for tier one or tier two people, here's 3 different calendar years that did not have to be consecutive that you had the most income. So we're going to take it from there. For an OPSERP member, they do need to be 3 consecutive years. So giving the school administrator, for an example, you would need to do 4 school years to get 3 calendar years under that PERS legislation. Now, if you're tier one, You get to include a payout of your vacation time. But for school teachers, that's not usually something that you really have. You have 3 personal days and they don't carry over. So it's not a big deal. But sick time is for both tier 1 and tier 2 people. You get 50% credit for the payout of sick time. And basically the way that that works is if you had 1,000 hours of sick time, they're going to look at how much you make now, according to your final average salary, and they're going to give you half credit or 50 cents to the dollar and add that lump sum in there. And if you had 1,000 hours of sick time, you might see a $400 or $500 per month increase in your pension. So for tier 1 or tier 2 people, really beneficial for you to not be sick. Sometimes people are on leave and they need the sick time to be paid out so they can keep their salaries high and their service credit high instead of getting it paid out of retirement. So it all depends on your circumstance. For OPSERP folks, you can just use your sick time as far as the calculation for the retirement side is going, because they're not going to give you any benefit to that. Now, as people get closer to retirement and inflation becomes more of a conversation for our day-to-day, you're going to see this blended COLA, they call it, cost of living adjustment or COLA. And with PERS, it used to be a 2% cost of living adjustment maximum. And now, if you have years of service after 2014, it's going to be 1.25%. PERS is not going to keep pace with inflation for the most part. And that's important for your planning overall because you might need other investments or you might just spend less and less in retirement. It kind of depends on what you're trying to accomplish. Now, a written estimate. This is where you actually submit a form to PERS and you either mail or fax it to them. And you say, I would like to retire within the next 24 months of when I'm sending this. A written estimate is going to have a real person take a look at your exact circumstance, and they're going to actually run all these numbers and send it back to you in the mail with a lot of information. So if you are more than 2 years from retirement, you can technically submit something up to 2 years from now, but it's not going to be something 5 years from now or 10 years from now. You'll have to do an online estimate if you want to get that far ahead. But you can certainly do the written estimate and say, oh, I want to retire in 5 years, but I'm going to get one for 2 years from now just to get a sense of what it might look like. I suppose that would be fine, although the numbers are going to be drastically different. So it might just create more pain than help. Now, again, 2 years, that's got to be your time frame. You send it via fax or mail. And on that information, you're going to tell them what you think your current salary is going to be projected for, tell them how many sick hours you would have at retirement, and they're going to run all of that information. They're going to see any gaps of service and so forth so they can get the best outcome for you. It's also going to take into account, for example, any divorce decree that's been filed with the divorce department within PERS. So sometimes that's a factor that you have to take into account. Now, if you're more than 2 years away from retirement, and you already know that based on the normal retirement age rules I gave you, well, then it's probably better for you to go to OMS or online member services. Now, what about the actual claiming options? Everything I've given you so far is this idea of you retiring and taking an option 1 benefit or a single life option, they call it for OPSERP. Same concept. If you're going to have 50% of your salary replaced, that is assuming that you are not going to have someone as a beneficiary or a survivor. And so that can change the numbers here. That's why this is helpful to see the 26 options that you have if you included purchases for tier 1 and tier 2 folks. Now, this question I just got in here, if I became eligible to retire in the middle of the school year, do I have to wait until the school year is over to stop teaching and retire? No. Actually, you can retire any month. It's always the first of a month. So there's 12 retirement dates per year, and you can actually do that at any point in time. Now, I'm going to show you a slide of considerations. Union contract benefits are going to be a huge consideration. If you retire in the middle of the year, or if you didn't give 30 days or 60 days notice, you might miss out on stipends and incentives that you could have gotten if you had the proper language and process, basically. But as far as PERS is concerned, you just let them know 90 days ahead of time, and you can send in your retirement application, and then they will let you retire January 1st, February 1st, or so forth. Most popular 2 retirement dates are July 1st for folks in education, or January 1st. So you might just not come back from that winter break, basically, is how that works. I will also talk about working in retirement, which is sometimes called working the bubble or double dipping. And that has its own process as well. We'll talk about that here in a second too. Now, like I was saying before, if you're going to retire with that 50% or 45% calculation, but then you look and you say, well, I got a spouse, I might want to factor them in here as well. Maybe even children that you want to factor in here. That's when things can get complicated. So let me give you an example. The most common options that people choose are option one and option two. Option one benefits, you can see in this example, is the highest benefit. This tier one or tier two person chose to purchase their wait time, which was about $1,000 purchase, and it increased $60 per month. So they said, well, if I'm going to break even in about a year or two, then it makes sense, I suppose, and I'll go ahead and purchase my wait time. The purchase cost for your wait time is dependent on your exact circumstance. It actually depends on how much money you were making right when you first started, which of course is different for everybody. And so it's not a cut and dry answer. I have seen it as little as $400 purchase for that 6-month time period, and as much as about $8,000 for that first 6 to 8 month period of time. So it just depends, but it's usually not going to be anything more than that. So with this person, if they didn't have a spouse or children that they were, counting on for their pension, they would probably choose option one with purchase, and they would get $2,800 per month for the rest of their life. But as soon as they pass away, the money's gone. And that kind of freaks people out. Because if you got hit by a bus 2 months into retirement, all that money that you've been paying into PERS for 30 something years, it's all gone. No one else can get to it. That creates a little anxiety for some folks, right? The refund annuity, option 15C, these can get pretty complicated. So I'm not going to go in depth because you can see that there's 26 variations here. But option 2 is that other one that I mentioned to you. And that actually covers one person, one survivor, typically a spouse or a partner, but you don't have to legally be married. So it's just one person that you can say, if I pass away, that person is going to continue getting the same exact dollar amount. Now you can tell it's less by about $300 per month. So in this example, let's use a spouse being the person that would probably be the reason that you choose an option 2 benefit. Well, you would have $2,500 a month coming in the door. So you basically told PERS, I'm going to take $300 less per month because the chance of me passing away and getting this money to my spouse is worth taking a $300 a month haircut. Okay. But you might live forever, right? All the way up till 110. And if your spouse died before you or whatever, you still collect that $2,500. The only difference is your COLA, the cost of living adjustment. That's why people choose option 2 is the peace of mind. If you have a spouse, if you passed away and they lost your PERS pension, that would be devastating for a lot of people's plan. And so they would choose an option 2. However, a point of caution, option 2 is based on the age of the beneficiary survivor. So if you try to put your child, then they will have probably 20 or 30 year age gap, and PERS is going to look at that, and it's not going to be $2,500. It's going to be like $1,800. Because could you imagine that PERS has to pay the child for the next 60 years or something like that? So those are some extremes, but that's why people choose option 2. The rest of them can get very complicated and complex, but it really depends on your overall strategy. Option 15C and option 2A are the next 2 most popular. If you're a tier 1 person, sometimes a lump sum combination option will make sense if you're younger, because you might have a mortgage still, kids in college, and healthcare costs that are really expensive for the first 10 years of retirement, but they're not going to be permanent expenses. So in my book, I actually talk about this. We have a discretionary type of portfolio for expenses that are not always going to be there. Your mortgage or your health insurance before you get to Medicare, things like that. You're probably not going to travel till you're 95. It's probably going to be for the first 10 years as well. So thus, tier 1 people especially, you might choose a lump sum combination option so you can have a little bit of that money up front as well as some of it later on. So you can see this can get very cumbersome, very complicated, but overall, that's what I wanted to make sure that you see these different benefits. And of course, in the actual grand scheme of this presentation so far, I've put the information here, but if you go back and watch the recording, then you can actually see this basically in written format. So again, tier 1, tier 2 people, you have all of these different options: lump sum, refund annuity, 15-year certain, and option 1. And for OpCert folks, the only thing that you have in this lineup here is what they call the single life option, which is option 1. That's what I started with in that last slide. Then if you go to the back half of those different options that I just listed out, option 2 and 2A, 3 and 3A, and then of course purchases. Well, all of these other options, OpCert folks, you have these available to you as well. They just call them survivor increase option, which tells you that if your beneficiary survivor passes away before you, the PERS member, well, then you actually get to go back up to option 1 benefits. And in the example I gave, that would increase your benefit when they passed away by another $300 per month for the rest of your life. So these are why there's so many different variations. It really depends on what you're trying to accomplish and what your spouse or child or dependents have and what your needs are to make sure that they're covered. Now, what about all these different working and retirement rules? Well, if you're tier one person, you don't have any limitations on working for PERS employers. Basically, what they said is there's not enough young people filling in the new positions. And so they kind of need those retirees to come back for a little while until they can get things sorted out. So, what does this look like in the grand scheme of your retirement plan? Well, if you're a tier one person in this example and you had 58, you're age 58 or 30 years of service, you can work as much as you want to. Okay. But if you didn't get to 30 years of service and you're over age 55 to age 57, you can work, but only part-time for a PERS member, a PERS employer, I should say. You can work as many hours as you want outside of the state system. And that would include private, positions. You can go work at Nike or wherever you want to, or you can go work in another state system like Washington or California or Nevada or whatever makes sense to you. But if you're going to keep working for an Oregon PERS employer, well, then you can only work basically 20 hours a week, or what they call the 10-40 rule. That would be an average of 20 hours per week if you worked all 52 weeks. But for an educator, you can usually get away with working about 3/4 time because you automatically have those breaks for December and the summertime and spring break in March and so on. So they basically limit how much you can work if you didn't get to 30 years of service. For a tier two person, same concept, but you have to be with 30 years. You can work as much as you want, or you have to be over age 60. Basically, you have to be normal retirement age. Now, why would people work in retirement? Isn't that contrary to everything that you've been hoping and dreaming, right? And the reason is of a strategy called working the bubble. And basically that came about from school teachers in education, basically. And the PERS folks said, hey, you can only work 1,039 hours. As soon as you get to 1,040, we're going to take the pension away from you and you're going to go back into active member status. And you go, well, I don't like that. But if I asked you right now, if you're making $100,000 a year, just as a nice round number, and your PERS pension is another $50,000 per year on top of that, wouldn't you want to collect both? Doesn't that feel pretty good as far as cash flow goes? And folks go, well, yeah, that does feel good. Well, what are you giving up to do that? Well, your PERS pension would stop growing because you went into a retirement status. So that $50,000, if you had just kept working and not collecting the pension, well, it could have been $51,000 or $52,000 and kept growing a little bit. But instead, you just take both. And so the reason people do that is so that they can effectively turbocharge their retirement. It means that they can have more in lump sum savings so that when you do retire, now you have that pot of money you need for your healthcare costs for 3 or 4 years or whatever it is. Or you might have all those vacations you want to do in the front half of retirement. So you're not as concerned about getting your pension from $50,000 to $52,000. You're more concerned about having $50,000 extra dollars in that different year. And that's why people do working in retirement, typically for just one school year. Almost always you're protected by the contract to actually do that so that you get to continue in the same role that you were always doing at the same salary and everything else. So you just got to make sure that you look at your exact circumstance with the union to make sure that you actually have those benefits covered. And if not, then sometimes you do have to ask for permission to do that working in retirement to keep your same exact role and so forth. So that was a lot of information. And now you're wondering, well, what am I supposed to do while I'm still working? So these are 8 considerations that I want to walk you through briefly. The first one is, what are my union contract benefits? If I have a gap, like I talk about in chapter 1, my retirement coordinates, if I'm going to retire at 60 and Medicare's at 65, are my union benefits going to give me that health insurance for 5 years? Or do I have to pay out of pocket? Do I need to get the marketplace health insurance, or am I going to go through the OEBB's retiree program? So many different questions with health insurance alone. For those of you in tier 1 or tier 2, you might have variable accounts, which can make things even more complicated. So you got to ask yourself, should I do the variable account transfer while I'm still working so that I can lock in my pension and not have it basically at risk? Then you have these voluntary contributions with the IAP. I'm not typically for it, but I'm not giving you specific advice. You know why we're not going to do that most of the time, because it's an after-tax benefit, but the growth is fully taxable. That's not a good plan. The IAP funds change every year if you choose to. In September, you have the opportunity to change your investments within the different target date funds. So you might want to take a look at that. You might also look at your statement from PERS and say, hey, I swear that my hire date was sooner than what I see here on my statement, or when you log into online member services. Well, in that case, number 5 is where you actually do a data verification process or account reconciliation process to work with that particular employer to make sure that you were in a qualified position and that they show you the records that they have. And then you can sometimes get that hire date moved up. That could potentially get you into a different pension if they, messed up on a really critical year, or it could certainly increase your amount of service credit and so forth. You might also want to plan for your purchases. There's 16 different purchases, but the most common ones are out-of-state teaching, any military time. There's 4 purchases just for military, or your wait time. And those are the most common that people will purchase. You can use a 457 and a 403B or your bank account to purchase those different units. Tax remedy planning, those of you thinking, hey, I'm going to trick the system here and I'm a tier 1 person that's going to move to Vancouver, Washington, so I don't have a state income tax. You might see a reduction in your pension because of the tax remedy, which is where PERS actually pays you money as a tier 1 person to stay in the state of Oregon and pay the income tax for you, basically, is how the tax remedy works. Or you might be someone who's saying, you know what, I have kids and a spouse, and I really want to make sure that they're going to be taken care of, or whoever you want to make sure you're taken care of. And you have PERS estate planning documents that you need to make sure are filled out, because there's rules that PERS uses to actually get those distributed to the right people. It defaults to a spouse, then to your kids. But from an IRS perspective, the IRS is going to limit how those distributions can occur if you did not specifically put someone down. And certainly PERS has their own power of attorney document as well. So if you're concerned, what if something happens to me on the hang gliding accident, maybe your spouse or friend or whoever, they need to be listed as your power of attorney. So the last thing I wanted to point out for today is, what are these different components and where does PERS sometimes fit into the grand scheme of it? This is what I call the retirement roadmap. And I gave you an example here of someone that's got these different IRAs and 403Bs and IAPs, it's alphabet soup, right? And you have all of these advanced premium tax credits from the marketplace. You have ideas like Roth conversions and Medicare and Social Security planning, life insurance planning for a pension max strategy. There's so many different things that have to go into this from a financial planning perspective. And that's why I tell folks, knowing the PERS information is a great start. But then you have all of the other components like the PERS health insurance program and me working part-time in retirement and the rules that there are for Social Security doing that, no matter if you're teaching or not. So many different components that you need to factor in so that you can make sure you're making the most of your wealth building throughout this process. So I'm going to stay here for any questions for the next 5 or 6 minutes. But I really appreciate your time today. I know that was a lot of information. I talked fast, but I really wanted to make sure that we get an opportunity to go through everything. Like I started out at the beginning, check out the book, Oregon Public Retirement, 23 chapters, 300 plus pages that goes step by step of exactly what you need to do and how to plan out all the different types and variations of your PERS distribution and investments and tax planning and insurance and estate planning. All these things come colliding for Oregon public servants. I have specific chapters on each of these components that go more in depth so you can really start to put this together. We're going to do monthly webinars, of course. So next month, we're going to do one as well. And so be tuned in with your emails from the union so that you can see what's coming up. And I'm going to stay here for some question and answer time. All right. This question is, did you say OPSERP members do not get sick time upon retirement? That's correct. It is sick time for OPSERP members is not paid into the calculation for OPSERP members. Now, you might sometimes find that a contract would pay you out the money, but that is 99% of the time not the case. So basically for an OPSERP member, when you get to retirement, you're almost certainly not going to have any reason to keep that sick time. You basically want to use it all. Great question. So again, check out the book, Oregon Public Retirement. Lots of great resources on our YouTube channel, podcast, and so forth. So until next time, I wish you guys all happy planning, and we'll see you all on the next webinar. Thanks, everybody.